Thank you, sir. Yep. Appreciate
Uh,
that.
yeah, and so first of all, if we can turn it over to those watching, can you share with the audience um, what is the X Fund?
Sure. I guess before that, just a little bit on just sort of the background. Just I guess, well, first off, thank you for having me. This is fun. It's good to see you again. As Sergio mentioned, we're colleagues and classmates from business school. Good old 2014 seems like eons ago at this point, doesn't it? Yeah, so I had the privilege really of jumping into the venture business in 2010, initially with DFJ, which was about a 4.5 year stint. And with fortunately impeccable timing, because as soon as I joined in, I think it was April 2010, they had just closed their 10th fund. So I got to work on a lot of their investments, not just in Fund 10, but I'd say funds 7 through 9 as well, that had some incredible companies that have just been pioneers in their respective spaces, including Tesla and SpaceX, and on the kind of infrastructure and application software layers, both Twilio and Box. So kind of got to grow up in this sort of environment where I got to learn from some of the best investors, and in many cases just be a fly on the wall and listen and learn, and got to work on specifically I think it was the Series B, or maybe Series A. I think it was Series B of Box. Early on, I remember there's 25, 30 FTEs in the company at the time, and I think they just moved locations. I think both of the co-founders were actually had also elected to have an office in an area where they could also just walk downstairs, make a left, and they could also sleep there as well. So there was some pretty intense dedication amongst both Aaron and Dylan at the time. But I remember that vividly as a 25-year-old being like, wow, these guys are really in it to win it. It's super impressive. Then they go off to build a multi-billion-dollar public company. But so we just sort of learned the ropes early on with a well-established venture firm, predominantly B2B application infrastructure software, and then some of the more deeper tech themes we talked about within space, whether it be SpaceX or Planet, the microsatellite company, or kind of in the future of mobility, Tesla. And then did grad school. That's how I met Sergio, which was a great time to be able to move out east, because I'd been born and raised on the West Coast. Actually born at Stanford Hospital, and kind of been in and around sort of the Bay Area and Silicon Valley.
You couldn't get away. You were born there. And just...
Yeah. No, I knew I had to spend some time out east and kind of build inroads in a totally different geography, and I, at the time, I was toying starting a company, or going back to the venture capital world, which we'll ultimately get into. But it's so fortunate to be able to spend time at HBS as a platform, as Sergio. It just sort of offers so many incredible avenues that you can pursue, and people that you can meet, and so I was fortunate enough to do that through 2014, and then I was not a founding guy at Rothenberg. That was Mike's fund. We were colleagues and friends from undergrad and business school, and so he asked me to join and help build the portfolio, which I did. And with our kind of core group of investors, it's a portfolio I'm very proud of. It was absolutely a team effort of the investment team there, and we were fortunate to be early checks in companies like Robinhood and Gusto and Andela and Patreon, and so in many cases, being able to leverage the networks we had from undergrad and business school to invest in colleagues and friends of ours that we knew were kind of walk through wall type personalities that had the ambition and and sort of founding stories and true gall and aspiration to win. And so many of them have been incredibly successful. I would have never thought a direct to consumer, mobile first application to do commission-free stock trading would become a multi-billion-dollar business, but here we are. So hat tip to the founders there for figuring that out, and then joined a very dear friend of mine to answer your initial question, Sergio, named Patrick Chung at Xfund. So Patrick and I actually met 2005. I was a sophomore in college, helping to run this. Actually, it's the largest student-run entrepreneurship club on any university campus, and of course, somewhat naturally, that's on the campus of Stanford. Just given how much entrepreneurship is just culturally championed at that university across all of its levels: undergrad, B school, Department of Engineering, et cetera. And Patrick at the time was a newly minted partner at NEA and was seeking for, to find, young entrepreneurial talent. What better place to fish than Stanford, obviously. And so we kind of forged a partnership and alliance between bases at Stanford and Patrick at NEA to build the relationship. And I think that's originally how we met Sam Altman, and kind of that was a great foray and kind of catalyzed our relationship. And then of course we looked at companies together when he was still investing with NEA, where he founded their seed practice and then actually headed their direct to consumer investment team for quite a while. And I was at DFJ, and so we just kind of built a friendship. And I joined him in I want to say early 2017 to continue to build Xfund. We have a bit of a unique story. The origin actually is rooted, has university roots as well. So we were co-founded initially by the new engineering school at Harvard University. NEA and Excel are two of our co-founding institutions and LPs, which is also a bit unique. And so we have this broader university thesis of early identification and of course support of founders coming out of universities that have culturally been bastions for entrepreneurship, and have really, as I've used the word before, or the phrase, we culturally champion entrepreneurship across campus. And there's probably a half dozen or so schools where we like to focus and we built institutional relationships and prominently with students and faculty to identify great talent coming out of these schools starting companies. And I'd say about a third or so of the portfolio are Harvard grads, but the other 2/3 are across a handful of other universities. Obviously, my alma mater, Berkeley and Stanford, and then Berkeley, of course, out west, and then out east, MIT, just on the road from Harvard and University of Pennsylvania. Really excited about what's coming out of University of Toronto and Waterloo as well. I think both schools did a phenomenal job continuing to build institutions to support those students that want to be creative and take more of an entrepreneurial path post-school versus a more kind of default career, if you will, in pursuing a job at Google or Goldman Sachs. So that's what we do.
So you identify the entrepreneur before they're working on a venture. Is that that's your approach? Is it?
No, it's not. No, I mean, you'd be surprised just how many, sophomores in college are working on something on the side, and are tinkering with a project, and have launched an MVP and are testing it. I mean, it's incredible what 19-year-olds are able to do these days, for example. So we are not identifying smart people and saying you should still go start a company, and this is great, we'll force you to do this. If you don't do this, shame on you. No, it's actually it's much more organic than that, with respect to the founder if already is keen on something. They have a unique story behind why they're doing this, what dislocation they saw in the market, their passion for a certain industry and why they want to solve it. Sometimes it's a family history story. Sometimes it's I did an internship here, and here. And I'm like, I saw this huge problem and I just want to go fix it. I was so frustrated by it. And then so we're usually there meeting the students anywhere from junior to senior year or first, second year in business school. We don't invest in full-time students. They're always going to be full-timers. Dedicated to their business, which obviously takes 150% of their time and effort to starting a company. But we'll meet them while they're still in their journey early on, while as a student, and then only when they're full-time and have elected to make that decision of pursuing it full-time versus, again, that more default career path. And that's usually when we strike as sort of first money in many cases, helping to catalyze or co-found these companies with these founders who are at this point of making a decision. Do I go back? Do I pursue Google or this offer to have at McKinsey, or do I pursue this company that I've been working on nights and weekends that I'm really passionate about and really want to pursue? It's only that much more helpful to take on not just capital, but a partner that will be supportive to you and help you recruit and make biz dev introductions, help you fundraise, et cetera. I'd say that's pretty much our bread and butter. I think I neglected to mention this earlier, and it's paramount. We're open to everybody, regardless of university affiliation. We're not exclusively backing Harvard grads or Berkeley grads, what have you. We've just built again, this sort of institutional machine and relationships with a lot of these universities to help founders, not just to source, but also to provide a layer of connectivity and institutional knowledge and research, et cetera, for our founders. So they're not exclusively graduates of these schools, but they need graduates of any other great university or even not. And we can leverage access to researchers or certain academics or actually data. We've helped a company that was founded by one Stanford Law School student, both of them graduates, actually there's two of them, help them to get access to and digitize some of the contents of the Harvard Law Library. So bringing to bear assets within these incredibly deeply resourced university contexts to help startups. So it's not exclusively backing alums from the schools.
Absolutely. And what size investments are you making?
So with our third fund, which we announced in September of last year, it's 120 million, fund 3. Fund 2 is 75 million. So we decided to upscale slightly, but not massively, as we're seeing a huge influx of capital into our venture capital, if you want to call it an asset class, and so we've kept it relatively small, and I think conducive to this stage and strategy that we've been employing since day one, which is, again, you call it now pre-seed. I mean, pre-seed didn't exist in 2010, 2011 when I joined this industry. It was sort of like seed, maybe get some angels, and so you had this few funds that had institutionalized seed, with Floodgate and First Round Capital and fantastic institutions like those. And now you have this, this sort of pre-seed environment where some folks have institutionalized pre-seed, and then there's the seed, and then there's the A. So I mean, call it what you'd like, but we like to be first institutional money in, usually leading or co-leading rounds. Round size is anywhere from $1 million to $5 million, roughly, when we're doing half. So I'd say our checks are 500,000 to 2 million, where we're leading rounds, again, co-leading rounds and setting terms, and helping fill out the syndicate. In fact, I'm doing that with 2 companies as we speak right now. We're leading both. And that seems to be a really good recipe for us, where even though we're entering with that 500K to 2 million as our initial check, we're actually earmarking upwards to 5 or to 7 million for that particular investment over time. So we like to come in at the seed or pre-seed and then ultimately reinvest all the way through, typically mainly through a series C or D in the company's life, to be aligned partners throughout the journey, as opposed to writing a check and then heading to the hills. So we have a pretty concentrated portfolio, as opposed to let's throw, a bunch of 500K checks out and sort of see what sticks. That can be a great strategy. It's certainly not ours. We prefer slightly higher ownership and alignment with the founders as, true partners. So we're trying to get and feel true partners and feel like true partners, and that's probably an ownership stake anywhere from 8 to 15%. I'd say on average. It's probably a good range. And then again, co-investing with others as a syndicate. We're not doing these by ourselves. We love to bring on partners who we believe are non-duplicative in skill set, non-duplicative in network, and can help the founder in other ways that perhaps we're less good at, perhaps. Yeah. And then continuing to follow on, seed all the way through Series C or D.
Absolutely. And some of the ventures that you mentioned that you're focused on are, high tech, like whether it's, using natural language processing, space tech, robotics, AR, VR, for the ventures that that are deep tech, and you're helping these founders kind of right out of college. What are some of are there unique things that you're looking for, especially for the hard tech ventures, to make sure that they can make the journey?
Mm-hmm. Yeah, sure. So I think thematically, if you were to look at our portfolio today and then going forward, I think it's going to be a pretty much rinse, wash, repeat. I'd say 40% enterprise, 40% consumer, then 20% digital health. And that digital health is kind of bracketed into both D2C and B2B. So on the B2C side, companies that are building, in-home healthcare applications, for example, or an early investor company called Natalist, started by Hallie Tecco, building a direct-to-consumer brand around women's fertility and helping women with the process of getting pregnant, for example. So, sort of D2C e-commerce brands, some of the health IT lens, and others not. And then on the B2B side within health IT, there's also in enterprise software companies. For example, we built back a company called Curebase, founded by a gentleman named Tom Lemberg, who is former Athena Healthcare, and he's building a distributed digital clinical trials management software solution. So helping companies that need to spin up turnkey clinical trials to be able to get to market faster and honestly cheaper. He's built a kind of all-in-one patient recruitment, management of the trial, and results also being sent ultimately to the FDA. That whole process usually is run, both very disparately and using spreadsheets. He's built a very verticalized software application to be able to enable that and streamline that process. They've grown 500-600x just this past year, in part with COVID being a catalyst. So that's a good example of a health IT, company, but more B2B in nature than B2C. Under the kind of umbrella of B2B and B2C is also quite broad, right? So under the B2B side, as I alluded to before, both infrastructure and application software solutions, mainly rooted in applied AI. So looking at a lot of NLP applications, NLP being natural language processing. So how are you utilizing voice and voice transcription and voice pattern recognition to be better in so many ways? A prime example will be back to a company called Kia, KEA, and out of Penn. The founder's a Wharton grad, and they're building an NLP engine to help quick serve restaurants to automatically take in phone call orders over the phone, and then send that order, understand it using an AI engine and an AI bot, understand it, place that order into the point of sale system, then have it then be sent out for delivery, full order to delivery transaction, all via software, as opposed to employing any call center or human involvement at all. So enabling kind of much more frictionless commerce to occur, certainly during this interesting time of much more kind of voice activated commerce. And so they're working with Domino's, Papa John's, Papa Murphy's, Five Guys, massive QSR chains that are national and doing considerable millions a month in revenue. And we were a seed backer there. They just closed actually a $10 million Series A. But I bring that up as a very unique and compelling application of voice, and that being NLP, a sort of subset of AI. And then on the another technique could be computer vision, and a prime example is we backed a team out of MIT, a business called Synapse, which was recently acquired by Palantir, and they were building a deep learning engine to identify threats and anomalies in X-ray images, starting with the beachhead and airport security. So when you go traveling, that is when we were traveling before COVID, and you have that army of airport security agents staring at that X-ray output image from your laptop or your belongings, your suitcase and what have you, and you had tons of people staring at the image trying to figure out, like, is there something wrong there? What's going on? Obviously we miss, unfortunately, a lot of things get let through. And a machine that has been trained on reams and reams of input data, such that you can understand the schematics of the laptop battery, for example, to see if it's slightly, a centimeter off to the left, or, there could have been dismantled or manipulated with such that it was a bomb, for example. Again, the human eye would never be able to understand or detect that. So really cool applications of computer vision for pattern rec and prediction as well. And so that's a good example with that company, Synapse. Another one, back to a team out of Stanford called Sirona. They're still in stealth, so I'll speak very less liberally about them, we'll say. But they're building a system using computer vision to better do patient diagnostics around radiology imagery. And not just the actual diagnostics, but the whole workflow associated with making the radiologist that much more productive per day and able to spend more time with the patient versus doing more diagnostics and having to share data amongst colleagues. So
with such a broad portfolio, how are you, what are the things you're doing to uniquely support across? Because I imagine it's very, they're very different across in terms of needs and
Yeah, that's the beauty of diversification, right? So we've done a few things. So I think for the most part, given our entry point is seed, founders at that stage typically are clamoring for help on engineering talent. And so with our and business development talent as well, to a certain extent. And we, with our university relationships, work very closely, in many cases, with the office of, I guess, recruitment or, talent management at these universities. And we're able to introduce and help recruit great candidates for our founders, given the university relationship. And that's just not undergrad, that's in specialty departments across our schools too. So if it's, a particular AI lab at Stanford, for example, if folks are looking for great NLP engineers or PhDs in robotics, what have you, like we're able to help fill a candidate pool that way. So I'd say recruiting is a really big one. And another one is I think we've almost a perfect track record getting our companies funded seed to Series A. So helping with Patrick and I's backgrounds in the venture industry, I think Patrick's been in it for almost 25 years, if not longer. But he, between the two of us, helping not just the firm, but the right person at the firm at that particular Series A focused institution. Many of which are folks that we've gotten to know over the years, and we kind of know what their tendencies are and their interests, and so we can help our founders fundraise with a lot more alacrity and purpose, because we're able to identify what we perceive to be the right kind of folks for their particular business to be a good partner for them and take a board seat. We don't take at the seed stage board seats. It's more of a syndicate effort with more folks around the table contributing versus actually having a board seat. But in the companies where we lead a Series A or whatnot, that's probably an opportunity where we would take a board seat.
Got it. And what are some of the things that you had to start to think about in going from a $75 million fund to a $120 million fund?
Oh, good question. Portfolio construction is a big one. As you're growing your AUM per fund, are you thinking about larger checks per company? Or are you thinking about more companies? Or are you thinking about more reserves per deal? Sort of how does that calculus all come into play? And how we thought about it was in fund 2, which is 75, you're going to have a handful of companies that have graduated C to A to B to C. And at that point, once they're through probably a Series A or B, their likelihood of us having recurring 30-minute, weekly or bi-monthly calls with them is going to be that need for that is a lot less acute, given more investors have come in or are on the table. There's a formal governing board, and so they don't need our help as much at that stage. You have some folks kind of rolling off in their need for our help, and then folks rolling back on as we kind of lead seed rounds and co-lead seed rounds. So capacity's able to kind of resume accordingly, and so. How we've done it with a slightly larger fund size of 120 versus 75 is we're in fund 2, we had roughly 30 companies, and in fund 3 we'll have about 35, maybe max 40. And so we're writing a few more checks, but we're also writing slightly larger checks. So I'd say our average in fund 2 was 500K to 750K. And I'd say fund 3 check size average initially is creeping up to be closer to $1 million, maybe $1.25 million. So we're writing, again, slightly larger checks and then earmarking a little bit more dry powder on the back end to be able to support our companies through their series. So that's how we thought of it. So slightly uptick in the number of companies and also the initial checks, and then of course the dry powder backed against them. But we're not changing our strategy in portfolio construction, really. I mean, we're not saying let's do like 15 more deals. Mm-hmm. It's a slight uptake that's, I think, commensurate to the growth in fund size.
Got it. I know you have a hard stop, so I want to appreciate you tuning in with us. If you have any, for those that are looking to connect with the Xfund, the link is in the podcast notes. So thank you, Brandon, for joining us tonight, and also congrats on the new fund, and for those in deep tech and these areas, check out Xfund. So
thank you so much. And I know I spent a lot of time talking about enterprise software, which is probably pretty boring for a lot of folks, but I'm also super interested in made investments in mobility and robotics and sort of space tech as well. So I'd say at our stage, so much of the underwriting is predicated on team, why now, and sort of growth in markets, as opposed to analyzing ARR and churn metrics. So we're very happy betting on 2 or 3 guys and gals and a PowerPoint deck and a great vision, and a phenomenal founding story where the founding team can articulate truly what best positions that particular founding team for a kind of a unique perspective or their unfair advantage to be successful in the particular market that they're operating in. So that is so much more important to me than, if they're, building the next, or if they're bringing back Beanie Babies, which maybe Sergio, you and I want to find the next cohort of entrepreneurs that's figured that one out. But yeah, it's trite, but it's so true on just sort of understanding the team motivations and their founding stories.
Absolutely. So thank you, Brandon, for that insight, and thank you for everyone watching for watching.